Hello and welcome to AI Market News by LM. Before we dive into the market action, we have an important message. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at our own discretion. Welcome to the deep dive. Our mission, as always, is to sift through that daily mountain of news, data, and research and really boil it down to the core intelligence we need for the week ahead. Today, we're deep diving into the global markets for Monday, October 20th, 2025, U.S. time. And while we're seeing quite a rebound of risk-on move, but the real question, the tension we need to unpack is this. Is this real conviction building? Or is it just positioning ahead of some massive catalyst later this week?
That is absolutely the core question right now. I mean, the week's starting off looking pretty strong, right? Shaking off Friday's weakness, those credit jitters we saw. The immediate vibe is positive. But yeah, we absolutely have to dig into whether this has legs. Is it sustainable?
Okay, let's tackle that equity surge first then. S&P futures are up, 0.4%? And Europe seems even stronger. Euro Stoxx 50 up nearly 0.8%.
Yeah, and U.S. pre-market is showing broad gains too. Dow, S&P, NASDAQ, all looking positive, around 0.5% up or so.
What strikes me, though, isn't just the green screen. It's how quickly that fear gauge seems to have calmed down. Volatility really spiked last week with those credit concerns.
Exactly. But look at the VIX this morning, the CBOE volatility index. It's down over 1%, sitting around 20.55. So less immediate panic, perhaps.
But 20.55, that still feels a bit high for a genuine all-clear risk-on signal, doesn't it? Suggests maybe some caution lingering.
That's a great point. You know, if we were seeing true widespread confidence, you'd expect the VIX to be comfortably down in the teens. That 20 handle suggests maybe some larger players are still hedging their bets. It connects back to those underlying sentiment measures, like the fear and greed components. We really need to look at things like safe haven demand stocks versus bonds and junk bond spreads to see if there's real depth to this rally.
Right, because a quick pop in equities doesn't automatically mean everyone's thrown caution to the wind.
Not at all.
Although it is interesting, despite all the nervous headlines last week, the S&P 500 actually finished the week up over 1.5%. That does suggest some underlying strength maybe in tech.
Definitely some resilience there. And that resilience is about to get a major test, isn't it? We are barreling headfirst into a huge earnings week.
Yeah.
The Mag 7 names are front and center.
Yeah, you can see it in pre-market already. Apple's up nearly 2%, Tesla jumping over 2.4%, Netflix gaining too.
And those reports, Netflix on Tuesday, Tesla on Wednesday, they're going to be the first real check. Is that resilience justified, or do we see some profit taking once the numbers are out?
Okay, so equities look brave, maybe a little too brave. Let's pivot. Are the bond markets singing the same confident tune? Doesn't look like it.
No, that's a key contrast. If we look at global currency and fixed income, the picture is definitely less uniformly positive.
The dollar index, the DXY, is a bit softer, around 98.322.
Yeah, slightly softer. But the main story in fixed income is weakness, especially ahead of that big U.S. CPI report on Friday. Look at the U.S. 10-year Treasury yield.
Back above 4%, trading around 4.010%.
Exactly, back above that key psychological level.
Why is 4% such a line in the sand for markets?
Well, it's often seen as that sort of benchmark risk-free rate floor. When the 10-year crosses it, especially moving up, it starts impacting the math on everything. You know, long-term borrowing costs, mortgages, corporate debt, global project finance. It ripples out. We saw treasuries catch a bid last week on those safety concerns, China tensions, credit worries. But that seems to be fading now. Inflation and the Fed are back in focus.
Okay. Looking at the major currency pairs then, Euro USD seems pretty steady, around 1.1653, just sort of treading water.
Yeah, relatively steady.
Yeah.
Plus 0.02%, not much movement. Seems like traders are waiting for that U.S. inflation data before making a big bet there.
But the yen, that's interesting. USDJPY is up around 150.76.
Still weakening. It's creeping back towards that 151 level against the dollar. And it's not just interest rate differentials anymore. There's a policy angle, too, perhaps related to supporting Japanese equities. It feels like a deliberate trade-off, letting the currency weaken.
Okay, connecting this bond weakness and global risk, we absolutely have to talk about France. That seems like a major headache brewing.
Oh, definitely. That's the big kicker for global fixed income right now, outside the U.S. focus. France got hit with a surprise S&P downgrade over the weekend.
They lost their AA rating down to single A.
That's right. And it's the second major agency downgrade in just over a month. It's not insignificant. You can see French bond futures reacting, the spread to German bunds widening.
So why does this one S&P downgrade matter so much, especially today on a Monday?
It matters because of the potential domino effect. All eyes are now on Moody's. They have a review scheduled for this Friday.
Oh, okay.
If Moody's follows S&P and also downgrades France, that could trigger automatic, forced selling of French bonds.
Forced selling, why?
Because a lot of very large, very conservative bond funds, think pension funds, have strict rules. Mandates that require the debt they hold to maintain an average RILA rating across the major agencies. Losing S&P's AAA puts them on the edge. If Moody's goes too, boom. They might be forced to liquidate potentially billions in French debt automatically. That's the real risk this Friday.
Wow, okay, that's a serious potential disruption. The cost of hedging that must be climbing. Let's shift gears then to the bigger macro picture and the geopolitical drivers shaping things this week, starting with the Fed.
Yeah, we've got some somewhat mixed signals from Fed officials recently. The St. Louis Fed president suggested policy is kind of between modestly restrictive and neutral. And he put out a warning, basically saying there's limited room for further easing before policy gets too loose and risks inflation again.
But then you had Fed Governor Waller offering a slightly different take, right? More conditional support for cuts.
Exactly. Waller said he'd only back more rate cuts if two conditions are met. One, the labor market shows clear signs of risk, and two, inflation risks stay contained.
And that second condition, inflation, really ties into this whole debate about housing costs and the CPI, doesn't it?
Precisely. There's this argument, and it's gaining traction, that the way housing inflation is measured with that known lag could pull core CPI down towards, say, 2.5% to 3.0% in the next few quarters. Even if other service prices stay sticky, this technical measurement lag is sort of giving the Fed cover to be patient, to wait for more data before acting on Waller's conditions.
Makes sense. Okay, shifting focus across the Pacific, China. What are the big macro forces there we need to watch this week? Their politics are in focus too.
Yeah, big week for China. The fourth plenum kicks off where they'll map out the next five-year plan for 2026 to 2030. And the signals suggest a real pivot towards boosting domestic consumption, moving away from the old export and investment-led model.
That's a major shift, and it comes just as we're waiting for their latest economic data today.
Right. We get Q3 GDP figures and September activity data. Expectations are pretty low GDP growth forecasts, around 4.7%, which would be the slowest in a year. Weak domestic demand, especially with the ongoing property sector issues, is a huge challenge for them.
And this ties into trade tensions, too. Based on the prepared resources, President Trump flagged rare earths, fentanyl, and soybeans as top priorities for U.S.-China talks.
Yes, and that rare earths issue, it's becoming absolutely critical. This isn't just trade, it's national security, supply chain security.
Explain that a bit more. Why are rare earths so crucial?
Well, they're essential for, well, almost everything high-tech. Defense systems, EVs, wind turbines, smartphones, advanced electronics. And China has this incredible dominance, controlling about 70% of the mining and nearly 90% of the processing globally.
90% of processing, that's enormous leverage.
Huge leverage. So securing alternative supply chains outside of China is a massive priority for the U.S. and its allies. That's why today's meeting between President Trump and the Australian leader is so important. It's scheduled for 11:45 a.m. U.S. time.
And rare earths will be a major focus.
Absolutely. Australia is seen as a key potential partner for developing non-Chinese mining and refining capacity. This is a long-term strategic competition playing out right now.
Okay. And finally, we can't ignore the ongoing geopolitical hotspots adding volatility, the Middle East.
Still very tense. The Gaza ceasefire is described as fragile. Israel launched strikes following an alleged ambush, and unfortunately, aid deliveries into Gaza are halted again. That keeps tensions extremely high.
And Ukraine.
Also contributing to uncertainty, particularly in Europe, President Zelensky is pushing for a freeze on current lines before talks, while Putin still demands territory. This stalemate drove volatility in European defense stocks last week. They're rebounding today, but the underlying uncertainty remains.
All right, so quite a complex backdrop. Let's bring it back to the week ahead and potential market movers. Consulting the investing.com economic calendar, what are the key points of focus?
Well, today, Monday, we have U.S. business inventories and the leading index, both at 10:00 a.m. Eastern Time. But really, the week builds towards the middle and end.
Right. We kick off major tech earnings with Netflix on Tuesday.
Then the big one, Tesla, probably the most watched Mag 7 report, lands on Wednesday.
Thursday, we have that EU leaders meeting discussing using frozen Russian assets for Ukraine funding, which is interesting, and Intel also reports earnings.
But the main event, the one everyone's waiting for in terms of market direction, has to be that delayed U.S. CPI report on Friday. That's at 1:30 p.m. U.S. time.
Crucial for Fed expectations. A hot number there could really shake things up.
Absolutely. And don't forget, all week we have China's fourth plenum ongoing in the background. And then Friday afternoon, we also get that Moody's review of France's credit rating. That could be a huge headline risk right into the weekend close, especially for bond markets.
Okay, so let's try and synthesize this. We've seen credit markets calm down quickly this morning, that regional bank scare last Friday. Seems like the market decided it was overblown. And equities have rallied pretty strongly in response, a classic risk-on move.
Yeah, but we have to ask ourselves, is this genuine conviction settling in? Confidence in growth, belief that inflation is tamed, or is it mostly just, positioning? Getting set ahead of these three massive potential movers later in the week, Tesla Netflix earnings, that French bond review outcome, and the US CPI print. Because the underlying risks haven't vanished, right? The tricky China situation, both economically and in trade, it's still there. It's just waiting for its moment, maybe later this week.
Exactly. So the final thought for us to consider might be this. We see this divergence of China potentially slowing, U.S. tech still seen as high growth. We see these geopolitical pressures building on critical things like rare earths. So how much does this Monday rally depend on hoping these global issues don't escalate further? And maybe more immediately, if that French bond situation does cause chaos on Friday, or if that US CPI report disappoints and basically ties the Fed's hands on rate cuts, how quickly could this positive sentiment just evaporate?
That's the billion-dollar question for this week, isn't it?
Indeed it is. Thanks for watching. Don't forget to like and subscribe.